The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick. These are your headlines. The Chinese reopen rally loses some serious steam with the blue chip CSI 300 index pairing gains of more than 10% after an official economic press conference underwhelms investors. The World Bank sounds a skeptical note on China's growth targets, forecasting a 4.3% expansion for the world's second largest economy next year, amid continuing trouble in the property sector.
In corporate news, Samsung issuing a rare apology after guiding for profit which is below analyst expectations in the third quarter, with the chip maker hit by a higher supply from Chinese rivals.
A very good morning from Taipei, coming to you from Hon Hai Tech Day, where Foxconn chairman Young Liu says the AI investment boom has still room to run. In a first on CNBC interview, he said the large-scale large language model is still evolving.
We are at level 2, I think. There's still level 3 and level 4 to go.
A big reopening day for the Chinese markets. We've been waiting for them to get going after Golden Week, and it seems as though some investors and traders have picked up where they left off. To me, the communique has been fascinating from the Chinese today because there are a couple of bits buried in the detail. One being using some of 2025's budget, so dipping into next year's kitty, trying to support the system. So if that's pulled forward, what happens next year? The other big point is around some of the terminology about the level of competition that the Chinese are facing. This was the terminology from Zhang, the chairman of the National Development and Reform Commission, saying that some industries are seeing rat race competition. To see incredible cutthroat competition on the ground for the Chinese market is interesting, given we're already seeing a challenge in Europe in terms of facing up against some of these industries. So just a couple of lines I thought was interesting, but I think for me what this means against the World Bank that is now saying, look, they're not going to get to a 5% target. The Chinese are really going to have to go at it if they want to get to that goal this year.
Well, they're not going to get there, are they? I mean, none of the evidence says it's there, whether you believe the official numbers or not. Look, let's go back to those markets. Yeah, I mean, should we talk about these moves? Now, let's assume these moves to the upside are not all about the national team buying, okay? That's a massive leap of faith, and I know we've all got our skepticism, but let's make this huge assumption that it is actually genuine investors buying because they think that the series of measures from the PBOC, from the government on the regulatory side, that it's all really going to galvanise the economy and get us back on track. It's kind of like, like you've got a lazy kid. Let's say you've got a lazy kid who's studying for their exams all of a sudden. They've suddenly realised they've got to study for the exams. It's like you're popping open the champagne corks and they've already got their straight A's. Well, no. Just because they've started working on something doesn't mean to say they're going to get the end result. There are a million reasons why that kid might have a bad set of exams and still flounder despite the fact they've started working. And I think the Chinese markets, if we assume that this isn't national team buying, institutional support for the market, it's like you're spending all your creds before you've seen the results.
Well, part of it may be a momentum trade, and don't forget it lost a lot of momentum, and this is a big weight as we talk about some of the international indices and the trackers. So today what you're seeing on the CSI 300 intraday, the rally that you've got 6+% higher at this stage, 4262 on the boards. Now Hong Kong sectors as a result, and this is where there's been somewhat of a fade. Don't forget this market's been trading in recent days, and the Hong Kong market now is down up to the tune of 5%. Some coming off the tech index, 7.2% down. There have been challenging stories in the region from the South Koreans about just how hard the technology space is for some to execute in. This from Samsung, but Hong Kong tech on the back foot. Property stocks also giving back some of the recent gains, and you can see how that is playing out. And the individual names, 25% down from Kaiser Group, Chinavanka down to the tune of about 24.5%.
Who in their right mind, unless you are the best day trader on the planet, and by the way, I'm afraid most of you aren't, who wants to trade this stuff? And I don't mean that derogatory. It's just like to be a good day trader and to trade this kind of stuff successfully is a very rare thing.
Well, it's spicy. You get those moves to the upside
But
to that tune, and you get to the downside
Let's
as well.
say you put Chinese property stock or Hong Kong property stocks in your portfolio because you thought, oh, great, all this stimulus as well. You're suddenly down 25% on your China Vanker. You think, crikey, what have I done this for?
It's a more speculative market, and it always has been. Let's get out to Sam for more. Sam, run us through the latest.
Very good morning to you guys. Yeah, I mean, you're absolutely right with the points that you've been making. It's a bit of a trade and a fade situation with the A shares and the H shares as well today, because we, of course, had the Chinese mainland markets coming back online, and putting aside all the sort of skepticism and cynicism around whether this is the national team at work, as Steve was sort of pointing out, we do know that, according to a lot of the media reports, that the brokerages have really been working overtime because of a lot of new accounts opening during that break. So some perhaps didn't have a holiday. A lot of those were sort of younger traders, millennials, a bit of a FOMO trade, building on the momentum trade, as you, Karen, were pointing out as well. So a lot of interest in this. And it seems to be very much on the intent rather than any sort of substance. And I think that's what was largely disappointing for the markets today, as to why we came off that sort of initial euphoria with those double-digit gains at the get-go, with the sort of 2.5-year highs or so with the Chinese blue chips. Because one of the reasons was largely to do with the fact that it does look like the market got somewhat over their skis a bit with what we were going to get today. They've been sort of mentally budgeting for 2 to 10 trillion yuan worth of fiscal stimulus to be thrown at the economy. But we've got to remember that this would only come from the Ministry of Finance. They were not at the briefing today. This is the NDRC. This is the very powerful state planner, which follows macro trends and talks about policy implementation. It doesn't come out with fiscal stimulus. So we were likely not to get that from the NDRC press conference anyway today. But still, the markets were hanging out for the specifics. As you mentioned, Karen, we did get some of the budget that was brought forward, 100 billion yuan for investments, and another 100 billion yuan or so for infrastructure projects as well. But the markets are very much hanging out now for confirmation on anywhere between these estimates we've had. This Reuters report suggesting there could be 10 trillion yuan, and then 2 trillion yuan, I should say, and then 10 trillion from a former central bank advisor that has been talking about government bonds that could help the economy as well. So there is expectation in the market that we will perhaps hear from the MOF, the Ministry of Finance, in the coming weeks to give an update on those details. The other thing, of course, is that there have been a few local media reports. I don't know if this is behind what we saw today in terms of coming off those highs, but certainly a few local media reports talking about calling for rational investment and avoiding blindly following the trend. So perhaps a bit of a message and some caution there for what economists have been talking about, inexperienced traders that haven't dealt with, say, the 2015 boom or bust that we saw, learning from those historical trends. So that was the market wrap and what we got from the NDRC today. Guys, I'll send things back to you.
Thank you very much for that, Sam. The World Bank expects growth in China to weaken further next year, falling to 4.3% from this year's 4.8% estimate, despite a raft of stimulus measures. This amid low consumer and investor confidence, as well as structural challenges like geopolitics and an aging population. Eugene Shao joins us now, the head of China Equity Strategy at Macquarie. Eugene, thank you very much for joining us. We are seeing a real acceleration and then a pause around China. The market's trying to grapple with what they're seeing, whether the stimulus is going to take hold, create some sort of base for the mainland market. What do you believe we're now witnessing out of China?
I mean, I think that right now, you can argue that things got overheated a little bit too quickly over the last couple of weeks. And I appreciate your guys' points about some of those developers really moved up very quickly. But from our perspective, we're really thinking about this as a new equity regime in China. And there are a couple of things, if you think about what's been going on in the equity markets over the last 3 years in this big down cycle, we would argue that there'd be three key headwinds, right? Which is effectively the macro, meaning the Fed cycle, the policy, which we think people just got over, and then geopolitics, right? And I would say three of those have actually turned, which is why we're still constructive on China markets going forward.
One of the items you've pulled to our attention in your notes is around the risk of Trump volatility. So this is interesting to see such big moves in the China market on the stimulus, all on the eve of an election. How cautious should investors be in case it is a Trump presidency?
I do think that there is a near-term risk in terms of kind of taking the momentum out of the current China rally from a Trump election. However, I do think that's probably going to be short-lived. Right now, you can clearly see a lot of the market interest has kind of moved away from the U.S. election and much more about domestic policy. But I do think once the election comes through, there could be a bit of a sell-off or kind of deflating that bubble with the Trump election if that were to happen. But I think longer term, it's not really a trade issue around Trump. It's really more about that structural China-U.S. rivalry and how that evolves. That'll be much more important for investors.
Eugene, I really take on board the three factors, but I still have concerns about all three. You and Karen addressing geopolitics, and only time will tell how that one develops as well. But on the other two, let me just go through it. Policy, I think great, a lot of supply side issues, a lot of lowering of triple Rs, etc., but it hasn't changed the fact that the Chinese consumers had an existential shock and still wants to save and still feels very uncertain about their property investments. And on the macro side of things as well, I hear what you're saying about the Fed cycle as well, but those concerns about higher interest rates have now been replaced by concerns about what kind of landing we're going to have. So I would potentially argue that all three of your original concerns are still there.
Yeah, it's a tough one. Obviously, from a macro perspective, that's a huge debate. We can all, we saw the jobs print on Friday, how strong that was. And you can see that immediate re-rating of the probabilities of what the next Fed cut is going to be. And right now, if you look at the markets today, I would argue that a lot of the softness, at least around the H shares, you could argue some sort of, profit taking. But I actually think if you look at where the RMB is at, we actually moved from about close to RMB 7 per dollar. Now we're closer to 7.05. And when you actually look at the correlation of RMB to China equity markets, it's very high. So again, this is why I think from the macro perspective, yes, I can still see there's a bit of a debate there. But if we are entering into a continued rate cut cycle and the RMB continues to strengthen, or vice versa, the dollar continues to weaken, I do think that will be a tailwind for equity markets in China.
Yeah, no, great points, Eugene. One more thing from me, though. There was a time when China built up these great private sector national champions. We had the Jack Ma's of this world, the billionaires, and they weren't afraid to show that China was back from the private sector. It appears to my untutored eye from the outside that things have changed dramatically now, that actually to be those kind of people that Jack Ma was, it's just not fashionable anymore. And actually this is more of a state-directed growth strategy rather than coming from the private sector. Am I wholly wrong, Eugene?
No, you're not. You're not. In fact, I think when we think about what we're calling here as a policy put equity regime, we don't think we're going back to those, let's say, 2020 highs that we saw. When we look at the valuation ranges of where we're trading there, we don't think that's probably sustainable. We will probably get to a level that's a bit more normalized. And part of that is exactly what you mentioned about that entrepreneurial spirit in China, which is going to be a little bit harder to pull back, even with some of the fiscal stimulus or monetary stimulus that we've seen over the last couple of weeks.
So Eugene, but does that change the attitude of the Macquarie investors who are looking to trade and get into Chinese equities? Because from my mind, I feel happier in Western markets when the government's nowhere near any of the stocks I'm looking at. I actually prefer the companies that have least government interference. Whereas when we look at China, we have to accept that there's going to be a different dynamic.
Yeah, I think right now it's still early days. I think that's probably the easiest thing to say, right? In terms of where the stimulus is at, how the government tone has changed. I think people are still figuring out exactly how willing they are going to be to support private enterprise, because that has been a bit of a bugbear in terms of when investors view what the policymakers have been doing. They've been very, quite cautious on how they've treated private enterprise. But I do think the tone has shifted. I think the urgency is there, and I think that there is a good possibility that they're going to be pushing more for a lot of these private enterprises to succeed in the future.
Eugene, I was looking at some of your stock calls and you say quality with valuation support. A couple of your top picks here include a retailer, an alcohol company and a mining company. Just talk us through some of the exposures that you're recommending.
Yeah, I think it's quite interesting when you look at how the markets have run. I do think in the near term, as we're seeing today in the H-share markets, there's a bit of a retracement risk. I think that's probably coming through, especially for a lot of those kind of high valuation stocks that have kind of picked up really quickly and are inevitably don't have the fundamental support, which is why we're recommending to investors to really go back to where do you think the beta is going to come back to once we get through this current sort of stimulus bubble, you could say. And I think that is going to end up being some of these quality names that do have the earnings support, which is why you end up with some of these staples names like these alcohol retailers or sellers, you could say, because they generally have very high returns, good cash profiles, and we think that can sustain through an economic cycle.
And I can see you've got an avoid on some of the what you call laggard re-raters, Jinko Solar, Chow Tai Fook, which is a jewelry retailer. What we've heard today, I was mentioning the point about this rat race competition that was coming through from the Chinese. What does that suggest in terms of companies or sectors to avoid?
Yeah, I think that right now, in the near term, we looked at the valuations of where the markets are at, and we would have made an argument over the last, you could say, year that China is cheap, quote unquote. But actually, when you look at where the markets are at in terms of the MSCI China, we've actually re-rated back to average levels, which means you can't really just pick any of these laggards up anymore, which is why right now, when we think about what you should be selling, it is really a lot of these stocks that fundamentally don't have the support. So you mentioned Chow Tai Fook, some of those solar names, some of those have structural issues, and that's why we're a little bit less positive on those names.
Eugene, thank you so much for joining us. I think we've had a lot that we've learned from that conversation and a lot of trades for investors. So thank you very much for that. Eugene Chiao with us, Head of China Equity Strategy at Macquarie. And you can find out more on our China coverage on the CNBC website.
Yeah, he was great, wasn't he? Fantastic. Right, coming up on the show, Samsung guidance disappoints. The vice chair issuing a rare apology. We'll bring you the full story next. Plus, it's a busy few days for chip earnings. We're going to delve into the sector in just over an hour. And UK retail sales, well, so much for worries about the consumer, see their strongest growth in 6 months. Wow. We'll discuss that with the Director UKI and South Africa of Software AG. That's Steve Ponting coming up in an hour and 15 minutes time, British summertime. Welcome back. Samsung Electronics says it expects third quarter operating profit to be around 9.1 trillion won. That's 274% higher than a year ago, but well below analyst expectations. The firm said it struggled with increased supply from Chinese rivals and delayed AI chip sales to an unnamed major customer. Well, let's get to Sherry, who's got plenty more on this mea culpa. Sherry, why were they so apologetic?
Because what they're good at is nothing related to AI just yet, or not the AI fancy stuff. And what they're good at is the commodity business, and the stock is down 23% year to date. So the vice chairman of Samsung Electronics actually issued a letter to customers, investors, as well as employees, saying that we're going to turn things around. We're going to restore our fundamental core competitiveness when it comes to technology, and we're going to turn this crisis into an opportunity. So they're good at this DRAM business, memory business, but there are concerns around memory cycle peaking out, or at least some increase in supply. And of course, that's what you headlined in the toss there. And then, of course, when it comes to high bandwidth memory stuff, of course, that is really stacked inside NVIDIA's GPUs. SK Hynix really just led the race here, and Samsung's late response is what they're paying for in terms of the price action here. And then today, there was that rare extra something explanation around this guidance for the third quarter. Samsung's management saying that HBM3E supplies, so that is the latest version of HBM, to a major customer have been delayed. So there is really no official green light from NVIDIA for Samsung Electronics just yet. And then I'm not done. What about that foundry business? Samsung is not able to improve their yield when it comes to their foundry business. In fact, Samsung's number is reportedly below 50% when TSMC's number is 60 to 70% when it comes to their yield as well. So there was that letter. We'll see how things go. Samsung Electronics shares down 1% for the day. It did gap down on the back of this earnings guidance, but hovering at this level. I think really the question is, what kind of memory cycle are we dealing with here? Is it going to be different because of artificial intelligence, and how Samsung is going to really turn things around, as the vice chair is promising? Guys?
Sherry, we've got a company here that's been in crisis before and managed to remake itself and become a real line of industry. To me, what's interesting is that the company's already been floating these ideas about creating models around AI, trying to monetize this big investment cycle. So as we see the pressure on what has been traditionally a very strong arm of the business, does that mean we're more likely to see in 2025 that the company will seek to monetize AI on some of its devices, trying to bolster its earnings?
So what it is that they just don't have the technology that SK Hynix and potentially Micron technology in the US have at the moment, especially when it comes to high bandwidth memory chips here. So that is the question. Will Samsung be able to really turn things around as they did many years ago when we were dealing with memory chips and not the fancy stuff? HBM is essentially foundry business. It's very customized and they need to be really working with their clients. So will Samsung be able to actually get to that technological level is really the key question. And this is something that also applies to foundry business as well. And I think that's the reason why in that vice chairman's letter, there was one of the promises was talking about they're going to look into the work culture, the organizational culture, and the way they operate. They're going to look into it. If they find a problem, they're going to fix it. Perhaps this is the moment that Samsung's innovation is being challenged. And were they too complacent with their memory business? I think that could be one question. We'll see how things go. I think at this point, the market is not going to be too impressed with, of course, what they say in terms of the memory cycle coming back, because they're moving on to the next generation of high bandwidth memory chips, and who knows what's coming next year. So will Samsung be able to get ahead to reclaim their technological leadership when it comes to this memory business? I think that is the quick question. And then just to add, there were some market speculations around whether Samsung will have to let go of its foundry business because it's loss-making. They don't have the technology. They cannot improve yield just yet. Although J.Y. Lee, Samsung's chairman, currently in the Philippines, accompanying the president there, answered one of the reporters' questions saying that that's not on the cards as of yet. Guys?
Sherry, thank you very much for that. Much appreciated. I think there's so much in the Samsung story today because I think for a long time we've looked at the diversified model we've seen from some of these big tech giants and it's been perceived as a good thing. But now there are disruptive forces coming into play and it does question the entire business model. I mean, we were talking about a company that is at the forefront of smartphones. And there is a view when the company's been looking at what to do with some of the AI it's been stuffing into the devices. And the reality is some of that AI is dependent on Google. So if Google, which has been throwing a truckload of money at AI, wants to monetize, and then they demand some sort of payment for it, Samsung has to do the same. So there is a potential now for there to be a paywall around some AI features. So you think about your phone, you got your phone, it did a lot of things, and we're pretty impressed with the smartphone. The AI phone in future may have paywalls around certain features, which means more subscription services for customers. And I think these companies are hoping...
Some customers, it's where I drop out.
Well, depending. If you get a device working at half speed. I mean, we pay for cloud services, for instance. We pay for, some people pay for Wi-Fi services on their phone. So it could be the next frontier where you pay for an AI feature on your phone too.
Yeah, I can assure you I will not be paying for any more on my phone.
Well, see, that's interesting already, the pushback from a high-end customer.
I don't know if that's very sweet of you to say so. But no, I don't need it. And in my life, I spend enough time on my phone as is. I don't need an augmented and improved... they're great devices. They're not phones, they're computers. You know, they're brilliant personal computers, and I don't need to spend any more money or any more time on it.
I think a lot of us would have said that about streaming services several years back, and here we are with multiple streaming services.
I don't watch TV either. I hate to say it to my bosses, but I don't watch TV.
Yeah, well, it does feel as though the trend now,
Too many things to do, Karen.
My point is that when you see the pressure on one arm of the business that has been a huge earner for a company, that it's now potentially going to go after other areas of revenue where it can, and this could be something to watch out for the likes of Apple and Samsung in terms of how they build revenue. Well, meantime, elsewhere in the industry, LG Electronics sees operating profit of just over 750 billion won in the third quarter. That represents a 21% fall from a year ago and is well below analyst expectations for more than 1 trillion won. OpenAI COO Brad Lightcap says the startup will use more than $6 billion raised from new investors to add processing power as it looks to develop its AI models. Speaking exclusively to CNBC, Lightcap also responded to reports the company was considering becoming for profit.
We're looking at that, as the company evolves, as the technology evolves, I expect our structure will evolve too. The cool thing about OpenAI is it's like we try and keep it this super dynamic company. I think we don't see it as we just did one thing and then from here on out it's just kind of incremental growth. I think we see it fundamentally as our mission is we've got to usher in this technology that's coming. The structure's got to evolve. The company's got to evolve. We're ultimately going to evolve our products too, and so more to come.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.